Tushar Pradhan, Chief Investment Officer at HSBC Asset Management, joins us right now on the show. Tushar, thanks much for taking the time out and speaking to us today on Bloomberg Quint. What are you doing, or what have you been doing in the month of March? The buying behavior of DIIs has at best been choppy. Enough number of profit booking into dividend-paying schemes. There's been some investment in the last 2 or 3 sessions, but by definition, it is very, very choppy in the month of March.
Well, I think from whatever we have seen that the flows continue to be pretty strong in the month of February by domestic investors into domestic mutual funds. The difference, of course, has been is that there has been some sort of hesitancy in the newer flows. And that is to be expected because there has been a fair amount of turbulence in the market right from January onwards. And that is not really anything to do with the domestic side, but more to do with what's happening in the global issues. For example, the Trump trade war and the threat of that, degenerating into something much more serious than we know. And all of those things associated with the cost of money in the US, especially the Federal Reserve and what it plans to do. So I think when you put all of that back, the choppiness may not necessarily be for the reasons that you talked about, but it would also be for all these other things which are happening. The other interesting news item I saw yesterday was some of the algos, once they reach a threshold in terms of very sharp corrections, then they take over. And this is something that we've seen before where, that can completely get out of hand. So I think we have to be a little careful to say what has been the cause for it. I think there has been a range of reasons why we are where we are. And of course, flows could be one of those things. But from a domestic perspective, and especially from what we are doing, I don't think we are doing any differently than what we were doing the month ago or a year ago. I think we're looking for value. Wherever there is an estimate of sustained ROE or earnings growth in a company, and which is now available at a reasonable price compared to where it was, I think that's where the focus continues to remain.
Okay, well, Tushar, good morning. This is Agam here on this side. I was running a check on the Nifty 500, and while the Nifty 500 on a year-to-date basis, that is a calendar year, we've seen a decline. The gainers have been predominantly mid-cap IT companies. We are looking at some amount of pressure today in something like a persistent systems. My question really is that have these mid-cap IT companies run ahead of their fundamentals, or are they fairly valued at these levels?
Well, I think you have to go back a little bit more in history to kind of see that while the larger cap IT companies were the flavor of the season for I don't know how many years now, the mid-cap IT has always suffered because of the lumpiness in their revenues, as well as their inability to kind of deliver on the margins on a quarter-on-quarter basis. And that is to be understood because they are smaller companies and they have much chunkier client bases. And as a result, the street did not give it that much of valuations for these companies. So the differential between large cap IT and mid cap IT typically tended to be pretty high. Now, a couple of things have happened. At the top end, when you are looking at the larger IT companies, they are struggling for growth for the past 2 years or so. So constant currency earnings, or let's say constant currency sales, have been in middle single digit for quite some time now. And obviously that has a bearing on how earnings also grow over this period of time. So earnings have significantly dropped. And as a result, the excitement around large cap IT has fallen. And we now are looking at valuations which are much lower than their historical peaks. On the other hand, the mid cap IT companies have started to become a little more critical than before. They have attained some mass, and the kind of growth now that they're seeing is significantly higher than their larger cap, more bigger, well-known IT counterparts. So I think it's more to do really with the discovery that now there is a potential upgrade for earnings growth in the IT side on the mid-cap universe. And I think that's probably the reason why these companies are, coming up in the screens. I would hesitate to think that, all of the mid-cap IT companies as a result will do well. Clearly, we have to be very stock specific and to understand the individual stories in each of them to conclude whether any one company is fairly valued or not. But as a group, I think it is benefiting from this larger understanding that growth might be, as a percentage, much higher in these companies than their larger IT counterparts.
The last few days, Tushar, has seen a bit of an unraveling in the commodity story, if not in the base commodities, then at least in the companies which cater this commodity space in the listed Indian pocket. What has your positioning been in commodities, and is it changing, or has it changed over the last couple of weeks, months?
Well, weeks, months is too short a time for us to look at a strategy, but I think over the past few years, we have been very closely watching.
Tushar, allow me to rephrase my question. The reason I asked this in the last couple of weeks is because the last 18 months have been fabulous. So a lot of people who were invested earlier would have been sitting on profits. So if you were indeed on that, have you changed that? Have you booked profits? That's the nature of my question, really.
Okay. No, that's interesting because clearly we have been overweight materials all out through this period. And we have definitely made the upside in terms of having the alpha generated out of these companies. Going forward, I think the volatility is led by a couple of things. One is, of course, that the demand is growing. So if you look at the top industrialized nations of this world, the G8 as we call it, they are undergoing a pretty significant and synchronous GDP growth rate curve. So whether you take the US, the UK, even the EU, there has been a pretty significant increase in GDP growth, which would translate into pretty high demand for commodities, which has started to come through. China has been a fairly surprising element where we also see strong commodity demand continue into this last few months and into this year as well, which has given the commodity prices a big boost. However, the controversy around the prices and certainly commodity companies now trading a little more volatile is due to the fact that Trump has been sounding the call on tariffs, especially for metal importers into the US. Though the direct impact, as we can see, is not really that much, I think the sentiment has been vitiated. I think a lot of people now are really wondering whether the kind of volume that can be generated because of demand will now be met. And if the price rise as a result of these tariffs actually negate the growth rate itself, and then it is not really very attractive. From an India perspective, I think it's an interesting move because higher prices globally mean higher margins for producers and intermediaries in the commodity sector in India. So for example, my costs continue to be Indian, but my selling price is dependent on a LME dollar equated price. So which means that if I manage my costs properly, then my margins will only go up if the price of steel goes up. We are not really that large an exporter, so the Trump effect is not going to be too much on Indian commodity manufacturers because most of our commodities are sold in-house and we are more or less a domestic economy. So I think in my view, the domestic side of the commodity business is not really that much a threat. And if at all, I think at the margin it might actually benefit from higher prices of commodities. But the bigger concern is that if these prices then douse this GDP growth that we are seeing in the last 2 years, then that's something else for commodity manufacturers to think about because the demand itself will maybe start to come off. So I think that's really where we are, and we still are fairly constructive on materials. We haven't taken a fairly strategic call to come out of it as of now.
Okay. Tushar, before we thank you, what's your top overweight position currently then? And the larger question will also be that are you currently overweight Indian markets, or are you playing it by the ear, waiting for better opportunities?
Well, as a domestic mutual fund house, we don't really have much of a choice when it comes to India, and I think that's a very interesting market to continue to stay invested. Globally, when we do our asset allocation, Asia ex-Japan, which is emerging markets in Asia, are very significantly attractive versus the rest of the world, given their valuations and the potential earnings growth. So we continue to be very, very positive on emerging markets. And within emerging markets, I think India continues to be a fairly bright spot because of two things. One is that we expect the earnings cycle to return, and we do believe that even if valuations are higher, they may actually incorporate this earnings growth already. And on a year-to-year basis, if you look at a much longer term going forward, 2 to 3 years, I think it's an interesting time to remain invested in the Indian equity market. So we remain fairly constructive in India. That's not the issue. When it comes to what we are doing, I think we continue to remain overweight on financials, consumer discretionary and materials, and to a certain extent industrials. And I think that explains the story. What I've been telling so far is that we do expect a earnings upside, and that's probably return of the economic cycle back up. So a pro-cyclical tilt in terms of where we think the next spate of growth is likely to come. And I think that's where we are at the moment.
Okay, Tushar, we'll leave it at that. Thanks much for taking the time out and being with us today. And hopefully all of us have a better next fiscal. Thanks for joining in today.